It's Sunday, September 25th, and the sell-off last week shouldn't be that big of a surprise to anybody that's been following the videos, because this is what we were expecting when we got a lower high. This high was lower than this high. Our thesis was that this uptrend was going to be invalidated. If we didn't get a tag of resistance, then we couldn't say that we were in this kind of a channel. So when we got the lower high, we were pretty confident that we were going to get a breakdown of support and in fact a retest of the lows. So that's exactly what we got. Well, it's basically a retest of the lows, and so far it's holding. But I don't have a lot of conviction that this low, if we can call it that, so far it is, but I don't have a lot of conviction that this low will hold, basically just by the way that it looks. You can see here that this candlestick basically came outside the third standard deviation band, just kind of touched it, which means the velocity of selling was a lot more than it was right here at this low, which is still outside the second but not outside the third standard deviation band. But if this candlestick right here, this low, looked like this one, or this one, or this one, or even this one, we either a big green candlestick with a long tail, or even a red candlestick with a long tail. Now you can see the tails here. Here's the tail, okay, the tail. Then that would basically mean that there was a lot of selling pressure throughout the day, but by the end of the day, the buying pressure brought the price right back up towards the open. But we did not get that here, so again, the lows are holding in the S&P 500, but we can't call it a high conviction low. So we go next to the Dow Jones Industrial Average, and it's basically the same thing. We've got the lows holding, but we can't call it a high conviction low just because of the nature of this candle. There was a lot of selling pressure, and there was some buying pressure towards the end of the day, and a follow-through day of a little bit of buying pressure, but we were still in the lower half of this candle here. So if it looked like this candle or this candle or this candle, again, we could call it a high conviction low, but it doesn't, so we can't. Next we go to the NASDAQ, which basically means all this is trying to say that the lows are holding, but we can't have a lot of conviction that we can just go buy a lot of stock. So the bias, the path of least resistance, is up in the Dow Jones and the S&P 500, but we can't have a lot of conviction that we're going to have a sustained rally. Here the NASDAQ is the best out of the three indexes, the indices. We have a double low here, low, a low. Then we have a higher low, we have a higher low, and again a higher low. Then we have this basing high right here, followed by a higher high, followed by a higher high. Very good things. We just connect the dots, and we've got ourselves an upward sloping channel. Okay, so the NASDAQ looks pretty good. And next we go to the trouble spot, the transports. These did not hold. We had a breakdown in the transports. This is a bad sign if you're using the transports as a leading economic indicator, which you can. So now that we have a breakdown in the transports, we listen to Charles Dow. Dow Theory says any kind of breakdown to a new low or conversely a breakout to a new high in the transports needs to be confirmed by a breakdown to a new low or a breakout to a new high by the industrials, or vice versa. A breakout in the industrials needs to be confirmed by a breakout in the transports. So one has to follow the other. It's a bad sign if the transports are leading the way down, but that breakdown won't be valid until we get, if you're using the transports as a leading economic indicator and thusly for market direction, it won't be valid until we get a breakdown in the Dow Jones Industrials either. But like we said, these lows are holding, but we don't have a lot of conviction that they will hold based on the interpretation of these candlesticks, that it wasn't a maximum sell-off, it wasn't a capitulation low like it was on these days, this day, this day, this day. You can see the candle opened here, and then it sold off, and then it closed back up. So all this selling pressure throughout the day was met with buying pressure by the end of the day. So we can conclude, if we have those kind of candles, that the intermediate term direction is up, but we can't do that right now. So we got to listen to the transports. Usually when the transports sell off, it might be something like the price of oil is going a lot higher. So then we follow oil to see if that's why the transports are breaking down, but it's not. Okay, these are the oil exploration and production ETF. You can see we've got a clear breakdown to new lows here. And this, again, shouldn't be too surprising for a couple of weeks now. We've been talking about that this little pennant pattern, this symmetrical triangle, could either lead to a breakout or a breakdown, and we would know pretty quickly, because if you break these symmetrical triangles up into three about equal parts or so, you're going to get either a breakout or a breakdown around the 2/3 part of the triangle. So somewhere around in this second third, we were talking about this being possibly a symmetrical triangle, and to watch for it. Now, these triangles work either way. If you get, it's either a pennant or a flag pattern where you get an uptrend with a little pennant, usually it's going to break out. But conversely, if you get a downtrend with a little pennant pattern, like that, you're going to get a breakdown. So that's what we were watching for, and indeed, that's what we got. So transports are going down, and oil isn't going up. So if the transports aren't getting a lot of business, and the market's anticipating weakness in the transports, and it's also anticipating weakness in the price of oil, thus affecting the oil producers' margins, and thusly making the price of the oil exploration and production ETF to go down, then we can assume that there's no demand. It's a demand problem. Okay, it's not a margin problem with the transports, it's a demand problem, and that's confirmed by the price of oil. So next commodity, after oil, we go to copper to see if copper tells us anything different. But unfortunately, it's the same story with copper. We got a major breakdown in the JJC, that's the copper ETN, and these are really, really wicked kicking gaps here. We've got, nothing but gaps here, gaps down. This is really bad. So copper, the country that uses copper the most is, of course, China. So we check for China to see if they have anything different to say. The FXI, the Xinhua 25 index, this is a pretty close approximation to the Shanghai index, also looks a lot like this. This is a huge breakdown as well. It's confirming what copper told us. We got a breakdown to new lows in the FXI. It's not a good sign. So we go from the FXI to the last two indicators I look at to kind of figure out what the economic situation is going to be going forward, which is the financials and the semiconductors. So the financials, if they're doing well, it means they're lending out a lot of money and making a lot of money on their loans, which means the velocity of money is increasing, which means a lot of people are getting to use money. Dollars are exchanging hands more times, so more people get to buy the things that they need and want quicker. So we look at the financials and then the semiconductors, and the theory behind the semiconductors is that the chips, the semiconductors, are a commodity of technology. When you have industrial commodities like iron ore and coal and copper and oil being used, it means there's high demand, it means we're producing things. When semiconductors are doing well, when their companies are doing well, it means there's high demand for the semiconductors, which means that all the technology gadgets that we all use as consumers and all the business technology that are being produced and used, like data storage devices, SAN switches, servers, all those have chips in them. When the semiconductors are doing well, it means there's high demand for technology. So we look at the SMH, and here we do not have a breakdown. This looks a lot better than the financials, and this is a good thing. So we look at the semiconductors here, we can kind of make out a textbook head and shoulders pattern. We have our left shoulder, okay, our complex head, okay, that's the double. We got this and this to make a head, and then we got our right shoulder, and then we have our neckline. So the interpretation of this is it's a reversal pattern. To what you need to have a head and shoulders bottom is a downtrend, then a left shoulder, and then a lower low, okay, followed by a rally to make the head, and then again a rejection of a breakout, and then a lower, a higher low, and then we get that kind of formation with a neckline, and then you get generally a breakout of this that had acted as resistance here. That's our neckline. Then we get a pullback to test this breakout level, and if it's a valid head and shoulders, we get a passing of the test of the breakout. So right here you can see it pretty much fits everything to a T. It's a classic textbook head and shoulders. We got our downtrend, a rally to form our left shoulder. Then we've got this as a complex head, and you can have those. Those are perfectly valid. Followed by a rally back up to the neckline, some to form our little right shoulder, and then we get a breakout, okay, and then we get a pullback to test the breakout level, and so far it's holding. So the SMH looks really, really good. So I would look for the SMH. We'll know on Monday if we get a little increase. If the SMH surpasses Friday's intraday high, so as soon as we get that, we got a good indication that the SMH is going to at least go back up to test here, and if it gets there, feel pretty confident that we could at least get to 32 to test this breakdown level here, where this had acted as support. We get this breakdown, so I think this 32 is going to act as formidable resistance. But on Monday, if we get any kind of move above this intraday high on Friday, then I got a good feeling that this sucker is going to at least 32. So that's the best trade for the week, and that kind of makes sense as we looked at the NASDAQ. So this is semiconductors. The NASDAQ is pretty heavy in technology. The NASDAQ looks the best out of the bunch. So technology looks like it's the place to be for this week. So that's a good one, is the SMH, or else for the brave of heart, we've got the 3 times bull ETF. So this is this triple leverage thing. So if the Philadelphia Semiconductor Index goes up 1 point, this sucker is going to go up 3 points. So for every dollar that the SMH or any kind of Philadelphia Semiconductor Index goes up, this thing is going to go up $3. But the inverse is also true because it's using leverage. So for every dollar down, if for some reason that I'm wrong and the SMH, does not break out, okay, if it doesn't do this and instead it does this, then for every dollar this goes down, that one's going to lose $3, the SOXL. But what we want to do for this week is just this. We put a stop right here. We buy this SMH on Monday, okay, and so we expect it to go higher. But if it doesn't go higher and instead it goes down, we're stopped out. No big loss, and we'll look for another trade. But that's it.